11.9% in the first quarter was not sustainable. The Chinese know that, and we know that. And there are a number of forces that will lead to slower growth. But the exit growth rate for China this year is probably going to be in the 8 to 9% area, which is an excellent result that paves the way for longer-term sustainability.
Well, at the moment, it's a good slowdown. We think the economy was overheating in the fourth quarter and first quarter of this year. It was obvious from around the end of last year that the government was withdrawing stimulus. We saw less infrastructure projects authorised. We saw the budget turn away from being stimulative at the end of last year. So we were looking for a slowdown, and this is what we've got.
Well, two leading experts on the Chinese economy predicting growth to slow. The question is, will it? And if so, by how much? We'll have the latest reads on that economic data today as soon as it breaks, and that's what, in about 45 minutes or thereabouts. U.S. economy may be slowing down, at least that's the view of the Federal Reserve. We had minutes from last month's meeting showing that the central bank officials felt that risks to the recovery had increased. They trimmed their annual forecast to a range of 3 to 3.5%. Still, officials saw no need to boost stimulus. They pledged to keep the benchmark interest rate at around zero for an extended period once again. Policymakers concerned about lingering unemployment, the so-called jobless recovery, and the lack of jobs in turn hurting consumer sentiment. Retail sales dropping for a second month, down 0.5% in June. That was worse than economists had been looking for. Now, those economic worries ended the S&P 500 six-day winning streak, the index slipping ever so slightly, ending the day essentially flat. Dow had marginal gains while the Nasdaq added 0.33%. Still, over the past 2 weeks, S&P up around about 6.5%. Well, it may be time to replace that famous bull statue on Wall Street with a bear. A new survey of investor newsletters showing bears now outnumber bulls for the first time since April 2009. Still, some analysts say sentiment is a contrarian indicator and increased pessimism is a precursor for a market rebound. Meanwhile, concerns over Europe's sovereign debt crisis continue to spread through the hedge fund industry. Hedge fund returns declining in the first half of the year after returning an average of 20% last year. How long will the industry struggle? Well, let's put this question to George Papa-Markakis. He is managing partner and CIO at North Asset Management. George, thanks very much indeed for coming in. Let's talk about what your view is coming to China or coming to Hong Kong when you take a look at what's happening in Europe and you see what's happening in Asia.
Well, one of the reasons why I'm here is also to find out what's happening with Chinese growth and Asian growth overall. Obviously, we're looking for Asian growth to take the lead in terms of the prospects for the future. And in that respect, it's quite worrying the fact that we're in for this, to a certain extent, synchronous slowdown. Obviously, we know China's going to slow down. The U.S.
But even when we look at it, 10.5%, I mean, that's a rate to be pretty envious of anywhere.
It is, but what really matters is the rate of change. And unfortunately, with this less benign G3 background, where we're seeing the U.S. employment numbers really coming in on the very weak side, the household housing continues to be extremely weak. And in Europe, the sovereign crisis is now morphed into a banking crisis, which is another problem.
That's the next step of it, in essence, isn't it?
It is, and it's a very difficult problem because unlike in the U.S., where you had the ability to recapitalize the banks because you effectively have one country, in Europe the issue is that you have several of the problematic banks, the banks that need quite a lot of recapitalizing, are in the southern countries, which don't have the ability that easily to tap the sovereign for those funds.
Yeah, but we do have that extraordinary fund as well available now to be able to do that.
It's true, but we don't, I mean, there is, I think one of the issues that the market is having a problem getting around is that there really isn't any clearly defined process in terms of how these banks are going to get capitalized. And then there's been quite a significant political backlash with using that money to recapitalize the banks. And to a certain extent, we saw that in the U.S., where again, it's only one country. So I would expect the same type of political backlash in Europe. I think so far what we've heard from Germany is they'd like to see private capital be used to recapitalize the bank, and only George, as a last resort.
There is the issue, though, is there's a lot of perception as to what is wrong with these banks. We've got these stress tests in the pipeline. When we have those undertaken, we get the results of them, then we'll be able to perhaps sort the wheat out from the chaff.
Well, we hope so.
That's the hope, of course.
That's the hope, and I do have quite a lot of reservations on that for several reasons. One is these stress tests are really being done on a national level. The economic environment that we're in is unprecedented. A lot of these banks effectively face their main issue is not so much, I feel, an issue of economic downturn, but it's actually the value of the assets that they have, the collateral that they're lending against. And really the stress test doesn't take into account the ability of the banks to tap the market for long-term funding, which is, why we're seeing all these banks go into the ECB.
Okay, but that hasn't stopped the euro appreciating, 6% already this month, which is phenomenal.
It's quite a good rally. I think a lot of that is on the back of, I would say, it's more technical than fundamental. You've had there's been a marginal fundamental support in terms of weaker data out of the U.S., but I think people were very short the U.S. dollar, especially the hedge fund community.
Yeah, I mean, how is your business doing at the moment?
Our business is doing okay. I heard you said before about the hedge fund industry overall. The returns this year haven't been great as for the industry at wide, which to a certain extent I think reflects the different operating environment. I mean, the industry is very resilient, and it's going to a certain extent have to reinvent itself after 2008. A lot of hedge funds were high beta, and certain ones were alpha, and I think you're going to see a bigger bifurcation in the way funds get managed. Yeah, you run, I think, the Max Q fund, don't you? That's correct.
Global FX, fixed income. What are you bullish about? What are you bearish about at the moment?
Well, I'm bearish right now for commodity currencies.
So sell the Aussie and the Kiwi.
I think the Aussie, the Kiwi, I would argue Brazil, South Africa as well. We're in for an environment, I think, of where these, the underpinnings of these currencies have been to a large extent China, either directly or indirectly. And also the bigger thing is probably we've seen an incredible amount of portfolio flow into those countries, which I think is starting to slow. Okay, and what are you bullish about? I'm continuing to be bullish the Swiss franc. I think it's going to be continue to get money, continue to attract portfolio flows, and also we're going to see the structural unwind that we've seen when it's been used as a funding currency. Probably I'd be bullish the Singapore dollar as well and the Norwegian kroner. George, thanks so much for coming in. Thank you. George Papamarkakis there from North Asset Management. Going to take you live to where it's happening this morning, a live shot from the Shanghai Stock Exchange, the scene of Agricultural Bank of China's debut on the market there. Shares poised to rise, apparently. We're going to have all the latest numbers and analysis throughout the course of the program. And do join us after the break as we bring you more of that. So do stay with us when Bloomberg News returns.
Strength comes from engineering the right plan.